Hey, how's it going, everyone? And welcome to the Goblin Hideout, the premier NFT finance podcast. My name is Ryan, and I will be your co-host today, and I'm joined with fellow co-host and Goblin Sacks community member. Hey, how's it going, Terry?
It's going good. Thank you, Ryan, for that introduction. And today we're lucky to speak with the co-founder of Metastreet, David.
Hey, David. Yeah, glad to have you.
Hello.
I think maybe to kind of kick it off, we listened to multiple podcasts preparing, for this episode, and really pumped to have you on the show. Listeners, go ahead and listen to the Delphi and Zima Red podcast to get kind of a longer version on David's background. But maybe, David, to kick it off, you can do just a quick TLDR of, who you are and how you got into space, what you were doing before.
Totally. Hi, everybody. My name's David Choi, and thank you guys for having me on. Very excited for all things Goblin Sacks, Metastreet, and collaborations down the road, but also just generally thinking about how we can capitalize the metaverse in an effective way, which I think we both have a similar mission on in collaborative ways. Hi, my name is David Choi. I guess I'll start off in the high level, like what I studied. I studied art market development, so like how art markets emerged in like really the Antwerpian 15th century, which was the original center of northern trade. That got me really excited in the space. And originally, for a long time, I thought I was going to be an art trader, and that's why I studied art history and finance. Studying obviously where art was originally traded as an asset, which was Northern Renaissance, not the South. And after that, my first official job was doing art lending, so collateralizing like artworks to give loans where we could in early 2014. This was kind of when art was really being financialized by individuals, not just banks. So it's kind of experimental. And there we were doing interesting pricing mechanisms, which involved option pricing. And that was up east in New York, where that evolved into a job doing investment banking at Deutsche Bank, where I did real estate, gaming, lodging, and leisure. So like shopping malls, casinos, but also mobile gaming and stuff like that. But it wasn't the most, both industries weren't so, exciting for me because, they were just a little, I guess, reverse Robin Hood status. I felt like I was just kind of working for the rich. And that's kind of what brought my interest when I was at DB, kind of exploring how to decentralize the capital markets in some degree. And that's kind of why I got interested in Ethereum in around 2016. Because when you work at a bank, you realize they're all the same. And you think like, how do we disintermediate these services in an effective way? I've gone to crypto. I've been really involved with angel investing since then. Being involved in the space, doing whatever I can to get into ICOs, that called Lend. And that kind of progressed into this modern like venture ecosystem. And I've been through the work like DeFi Summer. Before that, ICO Summer, or Layer 1 Summer, that protocol, all that. And then eventually NFTs came about, and this was a real fascination to me personally because I came from the art lending world. I never thought I'd be back in it, but here I am. And then Connor and me, we both, and along with Ivan, our CTO and co-founder, we started looking to like the NFT lending space, like NFT Fi, and we realized how inefficient it was. So we began experimenting, like how do we scale the capital markets for NFT lending with the existing protocols that worked and was beginning to show product market fit. Because when we joined, it was like 15 million of volume in NFT Fi, and as well as some other platforms coming out like Arcade. And we realized this was going to be the beginning of, I guess, NFT financialization, just combining all the movements like NFTs, DAOs, and DeFi. So what is Metastreet? I can jump into you guys.
Yeah, please.
Metastreet is effectively, it builds on top of existing P2P lending platforms. It's a liquidity routing and scaling protocol for NFT credit markets. It sits again behind these direct origination platforms and facilitates like diversified NFT credit exposure, because these capital allocators can have this perpetual secondary market liquidity, which increases the depth of the underlying asset, and it really abstracts away the fungibility and the non-fungibility by accessing the derivative, which is a promissory note that sits behind these platforms. because NFTs in of its like themselves are sometimes fungible at the floor level, but as we expand like the definition of what an NFT is in its inherent form, not just 10K, but like whatever, how it evolves, they have to be non-fungible and treated in that way. But yeah, and that's kind of what Metastreet is. We just help participants compete to allocate capital, control interest rates across any NFT type, and try to achieve like optimized capital efficiency. And all of this combined will help scale the GDP of the metaverse that we're living in the future.
Cool. Yeah, a lot of what you said, just me being a TradFi guy and having a TradFi background, a lot of what you said kind of resonated with me. Just to kind of like rewind a little bit, you mentioned that in like trad art lending, that art assets get valued as options. Maybe you can explain a little bit more about how that works, and then like really what works there that you don't think really works in NFTs.
Yeah, there's so many things. And so the option pricing thing was actually so art lending in of itself is really dominated by banks traditionally, because you have this like high net worth like office, PWM, private wealth management services, where they give you all these services only like super rich people have, like lending against your stocks, your private investments, and also your artwork and house, because buy, borrow, die is a model for ultra elite. So collateralizing your artwork is a very common practice. And these are usually structured as revolvers, which is pretty much like a credit card. You can pull down from it and pay back down later. And in 2014, you saw the emergence of private art lenders, not just institutional lenders, which had higher rates, but they were non-recourse loans. So, they didn't really have this contingency, and you would actually have higher rates, but the only collateral that they would have would be for specifically that artwork. And this kind of introduced this idea where the underlying asset's the only thing that matters. So what this guy Asher Edelman was trying to do at a firm called Aldershire or Artemis, and from there starting, he was trying to do like a sale leaseback of the underlying asset. This is very a common structure in real estate, where sale leaseback is kind of move things around on the balance sheet and the tax reporting. So it's more like a service where you're leasing as opposed to this intangible on your balance sheet. And this also means that you have the option to buy back your own artwork, which is essentially option pricing. You can do some simulations where you treat it more like an exotic than the vanilla asset. So you can use blockchains, use like a Monte Carlo simulation to value it. This all sounds great, and that's all really what it was. It sounded great to really get to a single number, which is a cost of capital of 10% or 8%, which is all you have to say, like, yeah, I'll lend you for that much. But generally, most loans in the traditional world, they are structured as revolvers. But the biggest difference there is that there's a lot of private transactions. Majority of the transactions in that world are private transactions, so gallery systems. The public market, quote unquote, spot, I would like to call it, is actually it's really just Sotheby's, Christie's, Phillips, and these other guys. Most of the volume that is really, really noticeable is during November auctions, which is kind of like September through November auctions around that time. And that's a spot market, but that's really propagated by irrevocable bids. An irrevocable bid is a guarantee on a floor price of not NFT floor, but the minimum price it can sell inside the auction, because that's sold before the auction, hence irrevocable. It's also known as a third-party guarantee. And that props up the market and the spot price, which means that the underlying asset becomes stabilized. And that's why the debt markets flourish, because the spot market isn't so volatile. That's one of the key differences. But also the use cases of art is quite differentiated, because it's used for it's kind of used for tax. It's like one of the best benefits. It's like you wait for it to appraise, you buy the asset, then you donate it at a higher valuation by reappraising it. There might be some emerging artists all the way to existing artists, and there's a lot of trading that happens behind the scenes. But another thing really incredible about the art market too is like the experience is really high, because it's an auction. It's very exciting. You kind of visualize that in movies. So those are, I guess, how art lending worked in my experience, as well as how the spot market developed within the art space. But I can talk longer about the art market if you'd like and the history of it, but I don't want to bore you.
Actually, Definitely. In fact, I was going to ask you a bunch of things, but you touched upon them. And I want to better establish this connection because option pricing is definitely something that we're deeply thinking about at Goldman Sachs. But we have these issues of, how do you determine volatility, especially in trad art markets or 14th century art where there isn't a lot of spot
exactly.
trading? And second, how do you have an oracle? What is do you just an appraised price? How do you determine if the option is in the money, out of the money, and things like that?
Yeah, so actually, there's there's actually a committee in the IRS that determines and makes sure that the valuations of artworks when donated is actually it's not being manipulated. So that's I guess it's a sharded proof. The option pricing was more like something that we did uniquely as an experiment. It's not like market practice. This was something we're trying to experiment with. And back then, we actually invented artist indices, because there's no floor assets besides maybe a Warhol, which has thousands of lithographs. But when it comes to an individual artist, you actually invent your own volatility index for each artist. It's one way to approach it. So when you have a people are like, those are 1 out of 1s. I'm like, no, that's just an indexing problem. It's actually just all Beeples, and Beeple has a floor. So that would be my argument for what is an artist's floor. Well, you have to invent your own number. It's not laid out before you. It's not 10K. It's however much you generated, however much he's going to inflate in the future. And this really was tested in 2008 when Damien Hirst did his big Sotheby's auction, which coincided directly with the recession. But that was one of the greatest sales ever, because you just see this. If you just look at the chart, you see this massive, thick scatter plot within 2008 when he was selling I think it's Sotheby's, but that's a classic example of essentially a floor and volatility being priced for the individual artists. But that didn't really scale as an operation. So, like I said, this was experimental. We tried it, and the vol was insanely high, obviously, but it's a lot more stable than you think with regards to how it looks on a plot. Because it continuously goes up. When it comes to blue chip, this is a mature market. It's been maturing since Zwerner started the art fair in whenever it was, 50s, 60s, 70s. And ever since then, art market transparency has had decades of becoming Veblen. And because it's quote unquote Veblen, and a lot of people gives it heritage value and cultural value, it kind of stabilized, and that's why lending has become more comfortable. In terms of the actual practice that happens with art lending, they have money and they lend it, and they say, yeah, we'll give you a 30 to 50% LTV, and that's it. There's no risk analysis for a lot of these guys. It's just it's yield generating, and it builds relationships with the client. And it's funny because in the real world, revolvers are also relationship building at the corporate level too, which is how these are structured as well. But yeah, that's to keep their private wealth management divisions happy. But the LTVs and the calculations behind it isn't a scientific process for most of the cases.
Yeah, got it. That makes a lot of sense, right? The likelihood that you're going to default on your, nothing against crypto dick butts, but crypto dick butt is much less than the chance that a high net worth individual is going to say, oh yeah, my Da Vinci, it's a little, you're going to liquidate it. Okay. You can keep it, right? But yeah, it's almost airy, just how, not to reveal too much, but at Goldman Sachs, we're exactly thinking about this issue. We're developing option pricing. We're realizing we can create, per collection VIX, but also because NFTs have so much more volume in specific fungible floors than you experience with 14th century art, we have the ability to do some of these sort of experimental pricing strategies that you guys explored, but determined couldn't actually use because vol was too high. Is that sort of what you think about in terms of NFTs versus art when you think about the strategy?
Yeah, and I think there's a salient difference between an NFT versus, how you categorize the NFT. Because right now it's all artwork, because it's a great use case for an NFT. It's by the way, we go back to past art markets. You actually, when you look at how the art world developed, there was actually internet-based art called net art in the 90s. So it's really Eastern European focused. It never took off because you couldn't own it. And because you couldn't own it, you couldn't sell it, obviously. That's why it never took off as an entire era. And modern art has become so like value focused rather than discussion focused, political, and that's my personal take. When it comes to an actual underlying asset, like what is an NFT to me? Which I know some people call it metaverse assets instead of an NFT. NFT is just anything that's fungible, non-fungible. Sorry. An NFT to me right now is art form where you can try to option price it, but they are in of itself right now unproductive assets. So art lending has been informative to me, like for say something like CryptoPunk that is more like an artwork or more like an identity, which is kind of like artwork too. But once they get more productive, cash flows when there's a metaverse to interact with, where you can use them for like fighting, where you can use them for like gains and income and generation, then the LTVs on these assets goes like much higher. The securitization of the art market's very low. It's like from some research, like 10 to 30%, because per asset you can't get that much for each one. Whereas a mortgage, there's an individual that's living in it. There's income, there's generation, and there's like it's lower in the Maslow's hierarchy, or it's actually like an investment that's generating yield, the rental yield that has a much higher LTV. So option pricing is used for the immediate term, but it's definitely not the future of NFTs, in my opinion, because the volatility of an asset matters less because it's not collateral value based; it's yield based. It's my opinion.
And on the note of yield,
hot takes into the future.
Yeah, but that's something I definitely want to talk about, because I remember you mentioned this yield based NFTs, and like I do at least like to think about NFT collateralized loans as something like like machine equipment financing or whatnot. And I know you're a huge RuneScape fan, and in the early days of RuneScape,
oh yeah,
you could lend out your like sword, your god sword, for other people to use. But to do that, like we have a unique issue, right? Because today you have to lock it in a vault or something.
Yeah.
And while it's locked, you can't use it. And there's been like EIP 2615 and whatnot to solve this issue, but it still hasn't been solved. Like, how are you guys thinking about solving this? Like, what is Metastreet thinking about? Like, what do you think will be sort of
conversation? Like, it's conversations like these that solve it. We all got to come together and bond in a bonfire, because even recently, I forgot which EIP it was, but Joey Santoro just did like a new like DeFi vault proposal, which was like one of the first of DeFi proposals in of itself. We're going to simplify vault offerings, but that took like well into the DeFi, like well past the DeFi summer to get that actually passed through at the EIP level. And 721s are shitty assets right now. I'll say it straight up. They're not that collaborative. You have to escrow them. It's expensive. It's not very efficient. You can't rent them, mortgage them. People have tried to do this before with past EIPs, and people are trying to push them in new forms. There's a great website called that's run by Annette called NFT Standards.WTF, where they're trying to re-standardize it. But the conversations of where these utilities should go, and kind of having a unified vision as an entire community for how we should iterate on the 721 to 1155 hasn't come that far, because I would argue like there's a recent conference, NFT Berlin, where I actually felt like the first NFT conference talked to people who had the same level of sophistication that we did, because people thought about it. It was quite nice. And everything else before that is like, it's kind of like a side event where you think NFT or metaverse finance, stuff like that. That's not really put to the forefront, because this massive disparity between the metaverse / NFT users and the DeFi users, even though there's been some connection there. But there's a very little view between them. Like the Venn diagram is so small of like what is an NFT DeFi user, and because there's no backing for it, things aren't getting passed, things aren't being thought about, things aren't being developed. That's why 721s haven't evolved in their form, because they think it's just art. There's so much more than that. It's a foundational building block of the world that we're creating. So I do believe in a future where this productive capital assets like equipment financing, but an NFT is no different to a sword or a house. It's just data that's in a unique form, and that can be productive if it's the right setting and the right velocity inside an economy. But right now the limitations of the app. You can do an SDK to do a rental like project, or like you can do like a lending protocol which like isolates it, but that's that's not a deed, right? That's not really unlocking the capital efficiencies that we need to create the metaverse.
Got it. Actually, on that note, I was going to ask you like a quick one. Like there's three solutions out there, right? There's the EIP solution, 2615 base layer solution. There's the RentFT solution, which is SDK integrations on the project side, and then there's a rentable solution, which is to have a wrapper, which of course also needs integrations on the project side. So I'm guessing that you kind of lean toward the base layer new EIP type.
Yeah, I mean, there's arguments against and for it. Like people say EIP, like you shouldn't mess too much around that space unless it's absolutely. I would argue that the metaverse is the number one app of the future. Like DeFi is a stepping stone to enable that. But to me, like that's why I like to call it like the metaverse capital. It's because it combines NFTs and DeFi. And I'm sure we've both played like RuneScape and stuff like that. Like if you don't play it, the end game isn't. There's no end game besides the economy. Like Diablo 2 died because the economy died. We weren't killing cows because it was fun and farming it. We did it because we wanted to win the economy. So the end state of the metaverse, people say the end state of the digital state, exactly, gold highs, and getting the Stones of Jordans. The end state of the digital state is the metaverse, but the end state of the metaverse is the economy. And the economy is DeFi. It's, you can't have these like very slow financial institutions doing loans for like instantaneous game assets in a market fair price. It has to be instantaneous. It has to be decentralized. It has to be extremely efficient. So the metaverse, the economy of the metaverse, economy and metaverse are pretty much the same thing. So I do like ReNFT. I haven't looked too much into Rentable World. Disclosure, I invested in ReNFT. But EIP looks interesting. But it's all experimental. And through the bear market, hopefully we'll chill out together around the bonfire because it'll be very cold. And we can figure things out to make things all seamless. And it can arbitrage between rental yields and mortgage yields. And you can like do interest rate swaps between force breeding loan and like compound, because one will be fixed and one will be floating. And that's the exciting thing that I'm super excited about in the future, because it's these kind of derivatives that you've always kind of wanted as a kid, because we were, I guess, mini bankers when I grew up. We were like, dude, what if we like could use I remember I used to have like two sets of like armors, one adamantium and one rune. And you'd use adamantium for wildy. It's more RuneScape talk, but just because it was capital efficient to lose all your assets in a risky endeavor. But imagine that for like rentals and stuff like that. Like it can make the economy grow so much bigger. Anyways, I'll stop there. The last thing I'll say is like, if you ever play Monopoly, you should try doing a peg between the US dollar and Monopoly dollar. Call it laissez-faire Monopoly. It makes it so much fun.
Yeah, 100% like RuneScape. That's where you learn market making, because you learn the best spread of logs. And then you see what fills on the Grand Exchange.
The Schmitties, man. I used to love the Rune Schmitties. But yeah, I mean, it's an easy example that we
I think you guys thought about game mean a little bit different than I did.
I mean, if you weren't market making on RuneScape, were you even playing RuneScape?
Yeah, well, the market making was the game. It's not killing units. That was just an excuse to create a currency. I like even like during Halloween when I was a kid, we didn't eat the candy. We turned it into a currency that we used for creating. It was like, it's funny. The best economy I like right now is actually Tarkov. That's like my favorite game with the most sophisticated economy that I think makes the most sense in terms of like the right syncs and stuff like that. And I love the Bitcoin story that happened there, where there was like a mini like simulated Bitcoin in the game, and it completely destroyed the inside economy because it was a gold-based economy where there's this money that people are trying to hoard, and then there's no velocity in the economy. I hate the digital gold narrative. Like that's mercantilism at its core. Yeah, I mean, I'm a big Tarkov guy now. I play some Valorant, but the market's shit there.
So let's keep on the kind of like theme of gaming a little bit. Maybe you can talk about. So one of the things that I was just a little unclear on, and you're just in some of the research I was doing, is you have the shipwreck game, and then Trade Weaver, and I think if I understood it correctly, Trade Weaver is like a component of that larger game and the educational platform you guys are building. And essentially, like building out like a community as a product onboarding program. Maybe you can, just touch base on the vision with that.
Yeah, absolutely. And Trade Weaver is a kind of like a proto version of the game that we want to develop. But there's always like a juncture point in the future of any product where if it becomes too complicated, either you favor institutional participants who are very sophisticated, and you kind of see that with compound and its governance, where you have like in the gauntlet kind of doing every single proposal and people just say yes to it, or it can like make it easier and digestible to do like day-to-day governance. And I think Curve did an incredible job with that, where you can actually control the cost of capital of a stable coin by doing gauge weight systems. But the interface of Curve is god awful. I'll say that out loud. Like people try to copy its version. I'm like, guys, it's not a good design. It just works because it's a very, very good product offering, not because the design is good. But making things digestible, like underwriting the complexity of how debt works, is a very boring job that I used to do. It was literally the last thing I was doing. I was like updating the interest rate of a third-rate casino in Deutsche Bank at like 3 a.m. in the morning. That's exactly where I quit. I changed it from 6.25 to 6.15, I believe. Yeah, like it's not fun. To make it a little more engaging, digestible, and understandable, starts off with education, which is pretty much like a digital ICM, where we're teaching them without them knowing that they are underwriting risk, which is why we call them shipwrights, because of underwriting. And the goal is that we can make it a little more engaging, a little better interface. And at the beginning, it won't be like a full fleshed out game, or will it ever be? But it'll be a little more digestible in the way that they understand how to optimize cash flows. Because if you're dealing with logs, it's a little better to deal with that visualization than to think you're making money. Because a lot of people, there is like a bit of a freeze. So it's, I like to say we're weaponizing cognitive dissonance, where you don't realize you're being productive, but you are. It's my general belief for what I believe Web3 really enables. If Web2 generalized like day-to-day labor, for example, Ubers or whatever, or just a little more blue collar, you and I would if you're a white collar person, likely you wouldn't do that job because there is like a almost cognitive dissonance there. But you will definitely chop trees for 20 hours, right? It's just like, that is a form of labor. Like people do this all the time, and they can leave like a lawyer or banking job and they'll do this. And if you can weaponize that in a favorable way and it doesn't have to be productive. You don't have to be folding proteins. It could be like you're optimizing your own capital markets inside the game. And we want to make it engaging and digestible for all audiences, because in the future, like if you want to control interest rates for your metaverse and be like a direct participant within, say, Axie versus like other platforms like Bored Ape Yacht's metaverse, like how do they compete? Well, I like to say if we ever talk to aliens, the language we would talk is interest rates. We wouldn't understand that. Like, yeah, man, can lower interest rates there, and that'll be the joke. But and so like making it digestible is a big goal for us. Like how do we make sure that people can understand it and still make it interesting? Because this identity of NFT DeFi, the combination, is still so primitive. And it's hard for like some people in the NFT world literally don't know what yield is or interest rate. When I say that, it kind of freezes them. But if it's bananas, then they get it. It's never coming. Yeah.
You just mentioned interest rates, and that's something that we do want to delve into. And I'm just going to assume all the listeners know exactly what Metastreet does. You guys have these vaults that buy promissory notes. Okay. My understanding of how you guys control these metaverse interest rates is that you would use the curve gauge system to direct token emissions and thus liquidity into these different vaults, and therefore set some sort of minimal overnight rate almost for these different like ecosystems. But like my question was, wouldn't you guys fundamentally be limited by the natural risk that specific metaverse poses? It's not like you guys have the ability to print print money,
Totally.
right?
Absolutely. This is the risk. It's I like this. To me, it's a bit more like sovereign debt when it comes to lending against an asset within a metaverse, because you're doing like an entire you're setting the rates of the loans based on the risk that it's covering, and that's kind of what you're trying to understand on NFT Fi, because there's three variables, right? There's duration, there's term. There's duration, there's interest rate, and there's principal. And these combine these three, and you can output, this promissory note. Thing is, up to now, like they're kind of connected by market forces. When you go on the platform, like, well, how do I structure this? What do I do? 30 days, 60 or 90 days out, or now whatever days, because you can do that. What should the principal be based on the risk that develops? And like you guys are thinking correctly, it is kind of like option pricing. But fundamentally, we're thinking of it differently, where it's a cost of capital calculation that we're trying to reinvent. Cost of capital for listeners is how the average cost of literally the market capitalization of a company is equity, debt, and sometimes cash too. But you get this like optimized cost of capital between the debt and the equity, where you can calculate how much they would be for each category. And we're trying to solve that, where duration will have a direct effect on interest rate, and interest rate will have a direct effect on principal and stuff like that. And they're all directly correlated, and you just pull a lever to optimize, the best structured offering, so the user is happy with offering. Maybe they don't want a high interest rate, but they will sacrifice LTV for it. And how do you connect all these together into a single discount rate? That's the big question that we're trying to solve. And that discount rate is then comparable between metaverses.
That last part is something that I'm super interested in, because I'm also interested in like a predictive ability of like speculative capital inflows into a certain vault, lowering the cost of capital, therefore also a sort of helping a metaverse grow inadvertently because people thought it would grow originally. Like, how have you guys thought about like what would be a unique quality of the specific metaverse world that would determine its cost of capital? And if you guys had this cost of capital like leaderboard, like what would be first, and why would it be first? Would it be just naturally interest? What would be the determinants?
It would be currency and currency hardening. This is how the IMF works, right? It's like, hey, you're printing too much money. You're in the Weimar Republic. Of course, your loans aren't worth shit, because it's the currency in and of itself, productiveness of the underlying asset. So, the position of the credit position controls everything above it, generally. And if it's too expensive, as we saw with FOMC, suddenly people aren't refinancing their houses anymore. Once everything's leveraged, the interest rate's the only thing that matters, in my opinion. It's generally true. And usually capital is allocated to where things are most productive, and people are willing to take a deeper dive on a lower interest rate for things that are more secure, naturally. So that's why U.S. Treasuries, because we think it's going to be there forever, they're usually pretty cheap, whereas Nigerian bonds might be 20% or something. And now you actually have this way where the interest rate tells the story of everything combined. So it's kind of this beautiful thing where a single number kind of explains everything. But generally, a lot of times you're trying to move capital where you might have outsides on risk and reward probabilities. But sorry, I think I'm going over the question. What's really the question?
Yeah, I mean, I think that perfectly answered it. And you brought up a super interesting point, because as we're right now, we're just equity allocators. And so we can allocate to these metaverses according to their cost of capital. But then later, when there's debt extended to studios or creators of these metaverses, then that's like a country risk premium. That's like a return on like a sovereign wealth, like a sovereign bond that's denominated. That's super interesting.
Yeah, it's very like Hamiltonian, right? He created the central bank and the federal charter because he, during the war, they literally couldn't finance the army. So if you combine all the state's debts, 13 colonies, into a single institution, then, and I know everybody hates the central bank, but I'm trying to justify why it originally existed, and if you could decentralize central bank. But the idea is like the future prosperity of the US, for example, in this case, will depend on trade. And how do you increase trade? Well, credit is the easiest way of doing it because of willingness of others to borrow you money to increase capital efficiency. Therefore, it could be more productive over time. And that's how interest rates can be focused and optimized, but also controlled from different platforms. Whether it's going to be participants like Goldman Sachs, whether it's going to be interest rate levers through us, or if it's going to be directly through loans in of itself through the promissory notes on NFT side. And all those together create something beautiful, hopefully.
Yeah. So basically, like the way I'm understanding everything and the evolution of Metastreet really is, so you guys like essentially started out more like a credit hedge fund, are focused now on purchasing the promissory notes, so more, I guess, analogous to a Fannie Mae. And then as you guys continue to evolve, it's going to look more like the Fed. Is that a pretty accurate, I guess, like summary?
Yeah, I mean, it's going to be kind of both, where the governance of our platform is like the Fed, whereas the actual platform in itself is Fannie, where it's setting rates, and that's like the go-to metaphor. Yeah, and that's kind of the thing. Like the credit fund was purely like a market discovery strategy because like 50 mil of volume wasn't enough to test the true depth of the market, and market clearing rate wasn't established. I mean, it might have been proper. Like maybe that is the cost of the vol at these rates, which are super high. But right after we jumped in, like the rates dropped like tremendously from. I think it was 290 in 1 month, which is crazy, to like closer to 50, and then it's been going down ever since. Flying Falcon had a great article on that of like what is happening, and that's why volume has increased. Well, the rates are getting lower, so what can you do with the money, right? How do you beat 50% a year? Like, man, you have to be the best hedge fund in the world to beat 50% a year, and nobody's beaten that this year at least, and to beat that, you need to, and if the more you lower it, the more opportunities arise to use the money to be more productive. Yeah, it's
and also, at least where I see you guys differing from just a central bank is that like you guys have this model where capital providers actually have to take the risk of the interest rate that they bear in the vault, right? Like I don't know how if you guys looked at Goldfinch, but it kind of reminded me of the risk model there.
Yeah, Goldfinch is awesome. It's like it's trying to bring meat-based yields, but I'm personally not a big believer of like middleman yields that exist traditionally because, well, for one, it's actually very hard to find good yields traditionally because, well, it's just not an easy task. Like you got to source it, you got to originate it, and I like my concern for a lot of these platforms, as it was with like YieldStreet, is like you get the worst deals when it comes to equipment financing to like peer-to-peer lending and stuff like that. And people in crypto think they can suddenly source all these deals effectively. I'm like, guys, it's people have done this for like years and years and years to kind of narrow in on those unique opportunities. Personal take. And also like it's so hard making yield in traditional worlds. It's like, it's very, very difficult to get a high rate that has low risk. Yeah, there's some limitations to it. I also just think that the metaverse is a scaling variant. It has a much bigger opportunity than to bring existing industries to have it scaled. And they think blockchain can suddenly solve it.
Got it. We do want to sort of, in the time that we have left, abstract away from the protocol itself and just ask you general opinions about, like, I guess, first of all, why build a abstraction layer on top of P2P projects when, a lot of people in the past were like, P2Pool, P2 contract is the way to go. Like we saw ETHLend versus Aave. Like why build a aggregation of P2P? But also, why build in NFT finance? You did touch upon this a little bit, but it's like, what do you see in the sector? Like, why are you so excited about it?
I am excited. I'll answer the first one. The reason why we didn't do P2Pool is because like if you look fundamentally at what we're dealing with right now, we're dealing with assets that have a very clear end use case, right? PFP is literally used for identity. It's like it's one of one asset. You could make it more liquid by fractionalizing, but generally in of itself, it is designed for a specific end use case. So is a house, so is artwork, so is even commodities to some degree, which is the most liquid, like non-fungible asset. There no box of commodities singles the other, even though they're both iron. Or like a house or equipment or any of these things, because they're made for a specific purpose. And that's what NFT is. They're usually made for a specific purpose. That's why they're not fungible. Money and stocks and bonds are inherently fungible because they're artificial, right? Stocks and bonds are designed on a piece of paper, and that's why you literally used to have a piece of paper that was like 50K or something, and you and sold them, and they're like stability and tradability and artificial liquidity is the inherent existence of these assets. Same with currencies, right? They're literally minted to be the exact same, the same price. So those things are very, very liquid. If you liquidate Maker right now, all of Maker, I don't know what billions it is, but usually you can liquidate all that within 24 hours based on daily trading volume. So if there's 10 billion of ETH traded a day, and there's 10 billion in Maker, you can liquidate that in a day. Because this is what we call capital market depth, because that's how deep the markets can take. And for those assets, it's incredibly deep, and that's why Aave and Maker kind of favor those models. It's pretty cool. Now NFTs are literally not fungible. There's literally 10,000 of them, right? That's all there is for a lot of these assets. And individually, well, first off, they're not designed to be fungible. They're not designed. That's literally why they're non-fungible. They have a specific end use case. They weren't designed to be instantly tradable. We've built a pretty unique market where there's a floor, and there's not really a bid. It's more like an ask structure. So you're already seeing inefficiencies fracture within the ecosystem. You can have like order book bids and stuff like that, but it doesn't resolve the bigger issue of it's not very easy to underwrite these individual assets super frequently, no matter what kind of AI you put down in. So what happens is that the market depth and the volume each day becomes very, very low because people are using it. People are literally putting on their PFPs. They don't move it very often. And that's why the borrowing markets on non-fungible things in the traditional worlds are usually pretty high, because that's how you source liquidity. But in the case of liquidations, like I said, Maker takes a day. If you were to liquidate, 500 Bored Ape yachts, I've actually done this math. It would take, assuming 2 mil a day. This was a few weeks ago because the market's changed so much. That could take up to 60 days to liquidate based on daily trading volume. That is systemic risk. And if you sell that in a single day, you've destroyed the underlying asset, where the success of the protocol begets its own failure. So the way to solve this is to just distribute over time, not distribute it over a single day. And a lot of people don't really see this as a risk, and they think they can develop very unique liquidation practices. But I'm worried that the market isn't deep enough. You could solve it with a lot of market makers who would buy it all in a single day. But right now, I think ladder maturity schedules is the right answer. And this is how a lot of people are thinking about it for privacy apps, or there's another one called Slow Swap, which is pretty interesting. One of the guys at FinTech Collective, and the answer was to slow it down. Latency is a feature; it's not a bug.
I think to close it off, maybe let's just, for the listeners, how they can get involved in Metastreet, where they should show up, and I guess what type of people you would be looking for to really help with the evolution of Metastreet.
Totally. Everybody should visit our website, metastreet.xyz. We are beginning to unlock our vaults pretty soon, but if you want to get more involved, you can level up on TradeWeaver. Our vaults are slowly rolling out, and we want to be a little cautious with it because we want to test out the bugs and the features, obviously, but also just make sure that we have enough volume for yields to be distributed to the users. So if someone deposits capital, we always want to kind of slowly progress and slowly unlock to make sure that there's a counterparty who's willing to sell, not sell, but sell a promissory note or provide a loan to make sure that there's another party. So the yields are still maintained as we slowly unlock, but also develop the platform, understand the user needs. But right now, like in the next few weeks, we will be increasing the cap of our vaults. So people want to deposit and get cash on cash yield. This isn't token inflation. We don't have a token, and any mentions of a token in the future is not from the team, or nor are we applying it. So it's all straight yield. It's kind of like Ribbon. Like Ribbon yields are truly cash to cash. And so feel free to join our Discord, discord.gg/Metastreet, and join the discussion. And if you're working on anything NFT liquidity focused, whether it's spot or lending world, we're very interested in spot liquidity. I think there's a lot of interesting things coming out of there that I'm very excited about, whether it's like FloorDAO or like it's Mimicry or a few other platforms.
Awesome. David, thank you for your time. And listeners, I hope you enjoyed this episode. Follow me on Twitter. I'm 0xTayTayHoHo on Twitter. That's Tay with an E. And you can follow Ryan at _Helmass.
Yeah, and that's _HELMASS. Thanks everyone for tuning in, and we'll catch you soon.